You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. You wanted it, you got it. A radio program that helps teach you options trading inside and out, basic to complex. This is Options Bootcamp. Whether you want to learn how to protect your portfolio, generate income, or even become a master of volatility, the Options Bootcamp drill instructors will break it all down for you. Now, let's get you into peak options trading shape. Here are your Options Bootcamp drill instructors.
All right, everybody. That music means we're back. We're back live with another edition of Options Boot Camp, what the cool kids call OBC, a.k.a. the show for you out there, the growing legion of retail options traders. A lot of you are new to the game. You want to learn how to take your first tentative steps into the world of options. Some of you maybe have taken a few steps and maybe thinking about upping your speed a little bit, starting to sprint. Others maybe want to dial it back a little bit. Maybe you fell down once or twice. Either way, doesn't matter what your story is that got you here, because we got you covered here and now. My name is Mark Longo from theoptionsinsider.com, as well as, of course, from the ever exciting Options Insider Radio Network. Glad to see so many of you are joining us there on the Plus and the Pro. Of course, if you'd like to join us live every week on the old Options Bootcamp. We were off last week. Very excited to be back. Someone, I won't say who, had to take a vacation. I don't know who that could be or what even this concept of a vacation is. But we're back live again this week. If you want to join us live, head on over to the Mixlr. Make sure you check out the Plus and the Pro so you can see what works for you. If you like it on demand after the fact, that's always available all the time for you over there as well. So whatever floats your boat, you like it on demand later after the fact. If you like to join live, get your questions in, like to get bumped to the top of the line, then Plus is probably for you. If you want to go above and beyond, you like all that live and all that good stuff, plus you want exclusive content just for you, including a cool exclusive podcast feed, well, then the Pro is for you, including you get those cool Pro Q&As. Had a great one with the short vol legend himself this week, Mr. Don Schlesinger. Also a Blackjack Hall of Famer. People sneaking in some blackjack questions for him as well, which was kind of fun. He did offer after the fact to me to do a special one-off for all your blackjack questions considered type show. So maybe we'll do one of those just for fun. But a lot of good stuff had over there in the land of the Pro. Check it out for yourselves. theoptionsinsider.com/plus or /pro, whatever floats your boat. Love to see you in there. And who are we seeing on the old show today? Well, he's back. He's tanned. He's rested. None other than Mr. Dan Passarelli from Market Taker Mentoring. Mr. P, welcome back from your globe-trotting vacation. How was it, sir?
It was wonderful, Mark. Yeah, all this hard work doing boot camp episodes, I needed it. But I'm back. Did a little wine tasting, did a little hiking, did a little more wine tasting, and it was really great. Made it back from Oregon before the 115-degree temperature. So
yeah, you missed it before the earth caught on fire out there. I have family out there in Oregon. They were telling me it was hotter over the weekend than 99.8% of the earth. It was like something like 116 or 117, something absurd. Only like somewhere in the Sahara, I think Death Valley, were hotter. So there you go, Dan. You missed it by that much, sir.
Missed it by that much.
You know what we don't miss, though, listeners, are our opportunities to weigh in and pontificate on all the madness that's been going on. Dan was gone, so we've been off for a couple of weeks, at least from a live perspective. You folks listening after the fact, nothing changed for you. You still got your double dose of content there throughout the week. But Dan, a lot's been popping off. We saw right after the last time you and I recorded live, saw a bit of a sell-off in the broad market and vol starting to spike. Then we saw that mitigate coming in afterwards, and we saw the markets pretty much have been drifting higher, and vol has been mostly drifting lower. Coming into this week, we saw a little bit of firming on the vol front. That seems to maybe be mitigating a bit today. People thought maybe some people were getting spooked out there. What's been going on? What's been lighting up your tape from a vol and a market valuation perspective? And what are the crazies over there at MTM? What are they slinging these days? So what are they coming to you for?
Yeah, it's been interesting, Mark. Well, they say tops take longer to form than bottoms. And boy, I don't know. For a while there, I thought maybe we'd be seeing more of a dip in the S&P 500. But, not surprised that it wasn't a big dip, but I thought there was a possibility. But I don't know. It just seems like this market could just keep going. But, man, at some point, a pullback's due, right? That said, there are a couple things that I was looking at. I was looking at gold, and specifically GLD. I kind of like to look at that one because it doesn't have some of the components that futures have in them. And so just purely looking at that, even though the charts end up being a little bit choppier in GLD, man, we kind of like bounced a little bit off a support level here. But if you look at a longer term chart, we're like 4 times higher than we were 13 years ago. And it just looks like there's a little bit of, if we break through support here, it looks like there's a little bit of room to pull back. So I bought some puts today and there. Another thing that I was looking at was DoorDash. And I've been long DoorDash for a bit now. And if you compare DoorDash to Uber, their biggest competitor, and like if you're able to look at a pair of stocks on a chart, man, DoorDash has been kicking Uber's butt for the past month or so. And maybe for good reason. They own 57% of the market, and that's not counting their Caviar acquisition. So it's actually higher than that. 60% of the suburbs. And so I don't know. Yeah. So there's a little bit of a pullback in DoorDash today. Maybe not a bad idea to scoop up a little bit more, in my humble opinion.
None of your opinions are ever humble, sir, but good stuff nonetheless. As we keep on rolling into our next segment, it is time for some options drills.
Hell in boots. Time for our favorite pastime, option drills. We're going to take the strategies learned during the show and teach you how they can be employed to achieve a specific objective. Do you hear me? Yes, sir!
All right, everybody, welcome to Options Drills, where we break down some options concept or strategy or just topic in a little bit more depth and explain how you can utilize it in your portfolios. Today's topic is kind of a add-on to what we were talking about recently. This whole meme stock frenzy has really just driven the topic of margin home. It's made it sexy and relevant for many people out there who never really considered it before, especially as they're encountering it doing trades to the upside and names like AMC and GameStop and everything else. So today's topic actually was inspired by a question, comes in from Trades with a Z. Trades says, new bootcamp trainee here, sir. Well, welcome, Trades. Welcome to the growing legion of bootcamp trainees. Says, I apologize for being late to the party. Well, better late than never there, Trades. A lot of people have joined the show over the course of the past year, a lot in the last few months. So you're far from the only one. It says, can you guys run down how margin requirements are calculated for options traders? Let's see. I seem to be bumping into that more these days. Yeah, you're not the only one. It says, thanks a bunch. You guys are the best. Well, okay, we'll take that. Maybe one of us is the best. I'll allow you to infer who I mean by that. All right. let's get into the world of margin. A couple of caveats before we start off. First off, this whole conversation is kind of going to vary depending on your broker, who your broker is and how they treat margin, what their margin requirements are. These can and do changed by brokers. Brokers will say many times on their site, the brokers can set their own house margin requirements above and beyond what the regulatory statutes claim. So a good example, I looked at IB before this show and their interactive brokers, and they charge a minimum additional margin of $150 on VIX trades. Petterfee's not a fan of VIX. So go figure. All these different places you look at kind of have different rules, different requirements. But for most of what we're going to talk about here today, we'll start off with kind of the most basic, most widely available, kind of old school options margin, which is Reg T. Dan, any thoughts in general about options margin and how it's calculated before we get into some of the specifics here, sir?
Yeah, I mean, just general thoughts. One thing that I think is a really great thing just to throw out there before we even start digging into the weeds here, because I got a feeling this is going to become a point of contention with some, is that margin really is designed to, well, it's really designed to protect the system, as far as the clearinghouse goes, and then the clearing firms underneath them. And then designed to protect the broker because they can be more stringent, and in some ways designed to protect you. So, let's just kind of go into it with that overriding principle. But I think we're going to talk about some interesting contrasting points to that.
All right, let's get into the weeds. I never thought we'd be breaking down margin, but you got to do what the people want these days, Dan. And, margin in the era of meme stocks, sir, margin is suddenly a sexy topic. You getting hit with a lot of these types of questions over there at MTM these days, Dan?
Oh, yeah. A lot of them, specifically with meme stocks. Let's see. I'm looking at our schedule here. Are we ready to start jumping into the meme stock margin stuff? Or?
Yeah, let's get into it. We'll go. So here, I'll set the stage, and if you want to chime in, you just let me know. We'll start off with the basic stuff. Again, we're going to start with your most basic, most widely available. If you go to Broker X and you throw $5,000 down, you have a very small options account, this is the kind of margin you're going to get. It's called Reg T. And it's pretty straightforward for a lot of the stuff we're going to talk about. It gets a little bit more nuanced when you get to some different positions. And, of course, in the era of meme stocks, there's new things added on top of that make it more fun. So we'll start with the most basic. You got a small account. You're coming in, and you're going to buy some options. Let's say you want to buy your call on XYZ, right? Or maybe you want to buy a put, whatever it is you're buying. You're just straight up buying a single leg options trade. Well, the margin on that is pretty simple. It's no real margin. You just got to pay for the cost of the trade. That's it. So if the option costs you $3, you want to buy a one lot, that's $300 you have to shell out, and bam, you're done. You don't have to add anything else. If the trade goes up, that money will grow. If the trade drops, that money will vanish. And that's pretty much it. So buying options, you don't really have to worry about the margin side. It gets a little bit more nuanced. You start adding in multi-leg spreads with, let's say, ratio short legs and things like that. Then things get a little bit different. If you're buying a 1x17 vertical, for example, it's not the same thing as just buying a one lot straight up spread, or straight up option, I should say. So just keep that in mind. Basic spreads like verticals, buy one call at the money, sell a call farther out of the money. Same thing for the puts. Those types of spreads, pretty much the same thing. You're going to pay the cost of your spread, and that's it. And then if it goes up and it moves into your spread range, then you're going to make money. If it goes away or kind of hangs out, you're going to lose money. That's pretty much it. Traditional butterflies, you're not getting super crazy, not messing with the ratio, not going farther out on the strikes, just going out, let's say, every 5 handles and doing 1x2x1. Your straight up traditional butterfly, also pretty straightforward. Kind of just pay the cost of that spread, and then you're good to go. And if it moves your way, you're happy. If it doesn't, or if it kind of just sits there, you're not. Dan, anything to add on kind of the basic outright buying of options before we get into the dark side, sir?
No, the basic outright buying of options, look, it's pretty straightforward, right? Like, it's typically the most you can lose is what you have to put up in margin. And, that makes perfect sense. There are a couple notable exceptions, like, for example, married puts, where you actually have to put up more than you can possibly lose because you have to put up the value of the stock, or you could buy the stock on margin. So put up 50% of the value of the stock plus whatever you pay for the put. That's one sort of example when it comes to buying options where it's a bit poorly designed, but generally speaking, overall, it's pretty fair, pretty reasonable. Whatever you can lose is what you got to put up.
Pretty much, yeah. It's a good thing to keep in mind. Whatever you can lose, really, is what you have to cover. That's what the broker, that's what the system is worried about. They're not worried about how much you can make, but how much you can lose is the issue. Let's get into now the basic example where people usually kind of bump into margin requirements first. These days, it's the other side, is the meme side, the call side. But the way people traditionally bump into margin issues is selling naked short puts. So we'll start there first. Let's go to everyone's favorite name, XYZ. Let's say it's trading around $50. You decide, you're going to go $10 out of the money. You're going to sell a 1 month 40 handle put. You're going to get $1 for it in our example. So there you go, 40 handle. So you collect $1. You have that $1 to the downside. So the worst that could happen to you is the stock goes to zero. You sell a 1 lot. You could lose $3,900. Remember, that's a $39 strike price effectively once you add in the price of the put that you collected. And then times 100 from the multiplier. So the most you could lose on a 1 lot is $3,900. So your margin is going to be somewhere between $0 and $3,900, right? Now, it depends, again, like we said, on which broker you use and what they do from a margin perspective. But your basic Reg T margin, I pulled this example, for example. I looked at a couple of different ones, but the example I ended up pulling was some interactive brokers. They're kind of known to have some of the more favorable margin retreatment out there. So they do it a couple of different ways. For this one, for example, they're going to margin you for the put price, so the actual amount you're collecting there, plus whatever is higher. So they have a combo there of either 20% of the underlying price minus the out of the money amount. So in this case, you're $10 out of the money. So 50 minus 10, you're talking 40. So 20% of that's going to be $8 plus the put, so $1. So it's going to be $9 you have to put in for margin, or just straight up 10% times the strike price, which in this case would be $4. So 4 plus 1 would be 5. So obviously the higher of that would be the 8 plus 1, the 9. So they're going to put away $9, make you hold up $9. See, when you sell this put, you say, I'm going to collect $100 for every 1 lot I sell. You don't think on the flip side of that, you're also going to tie up nearly $1,900 worth of your trading capital to collect that 100 at the end of the day. This is what I always say. This is kind of the unheralded, forgotten opportunity cost that goes into selling puts and any sort of premium harvesting type strategy, is that you're tying up capital. And so it's up to you whether you think that calculus is worth it, if it's worth tying up that capital, or maybe you can use that capital more efficiently somewhere else. So it's up to you how you want to margin. Other brokers do it a little bit differently, so we can get to that in a little bit. But any thoughts on that, Dan, of just your basic short put margin there, sir?
Yeah, that makes a whole bunch of sense. Pretty straightforward. Yep, exactly. Yep.
I think some brokers may just do 10% of the strike, 10% times the strike price out there. So it kind of depends where you're looking. IB has this kind of the greater of. I think maybe some of that may be a recent addition due to all the meme stock madness going on out there. All right, let's keep on rolling into the one everyone's kind of fixated on right now, which is the short call. Dan, whoever thought the conversation around margin would become a short call question? Usually it's a short puts, right? But these days everyone's all flummoxed about short calls. You were talking about on the show recently how you couldn't do your AMC. They were tying up too much capital to make it worth your while to sell any calls. Those AMC 145s keep trading. So we're in that weird kind of world, listeners. Back to the same example, XYZ trading $50. You sell the other way. You go $10 out of the money on the call side, sell a naked call on the 60 strike 1 month out. You collect $1 for it again in our example. We just like to keep the numbers nice and round and easy. So again, we pulled this from the same source to keep things uniform here. So the IB, how they margin that these days, you look at the call price. So again, your $1 plus, again, the maximum of. So whichever one is greater. 20% times the underlying price minus the out of the money amount, $50 minus the $10 out of the money. So you're talking 40. So again, it's the same thing. $8 plus 1, $9. So $900 per 1 lot, or 10% times the underlying price. In this case, that would be $5 plus 1. That'd be $6. So obviously 900 is more than 600. So you're going to pay $900 in margin. Now you can see why people are playing with this kind of stuff a little bit. And I think this actually sounds like it's low to me. I wonder if IB hasn't updated their website in a little bit, because other brokers have made things much more draconian on the selling naked call front, particularly in some of the meme names out there. Because think about it, listeners. You're selling this call now at $60, and the theoretical loss is unlimited. Unlike selling the put The most you could lose is if the put goes to zero. On the selling call side, it's like shorting the stock. Once you get above a certain strike, that's it. The loss is unlimited. So how do you really calculate an effective margin for something that could be an unlimited loss without making it ridiculously onerous, making someone put away $1 million on the side for cover margin to sell a one lot? That's absurd, right? But there's a lot of ways you could do it. Brokers try to do that balance between making things tradable, but also covering their butts in case it goes the way of the dodo. So that's something to keep in mind when you're doing that. Other places, so Toss, for example, Thinkorswim, their short call margin heading into all this, again, I would wonder if some of these haven't updated their website. Just 10% of the current market value of the stock plus the price of the option. So that would be back to the $6 or $600. So that'd be less than IB, which is kind of interesting. Again, in this environment, people are not exactly selling calls easier. They want to make it a little bit harder out there. So they don't do the maximum of. Maybe that's IB's addendum for the meme stock madness. Maybe they added that maximum of the greater of those two recently. But Toss still says just 10% of the underlying value plus the options price. Now, other brokers have done things a little bit differently. Schwab, for example, has effectively banned naked selling on a lot of these names out there. You just can't do it. So they decided to go the other route and just say you cannot do it. So again, it's kind of a pick your poison. It's very much a fluid situation. It's kind of changing by the day. We've seen intraday things change in names like AMC and GameStop, right? So take some of this with a big grain of salt, because some of this could already be outdated by the time we're reading it, let alone by the time you're listening to it, whenever that may be. So these are your basic requirements for these positions most of you are going to be putting on these days on the dark side, which is selling your basic puts, selling your basic calls. Dan, anything to add on that? I know you bumped into this recently in your own trading out there in some of these meme stocks, sir.
Yeah, well, here's a big warning of what can happen. You know, Mark went through the whole example, showed that I think you said with TOS in your example, you had to put up $600 for margin, right? So that's all fine and good, and you're looking at your buying power, and you're like, oh yeah, you know, I've got an extra 20 grand to do trading that I can use for margin. And then all of a sudden that stock that you sold calls on runs up just a little bit, but it's a meme stock. You could be still $100 away from the price. Like you would have to rally, in my hypothetical scenario, 150% over a 3-day period, like almost impossible. And all of a sudden, the risk manager at your brokerage firm freaks out because there's too many people who are short calls at his firm, and says, oh my God, we've got to increase the margin requirement right now arbitrarily. And I am king. Here's the new law. It's not $600 you have to put up, but it's $20,000. And they do that. They can do that, and they do that. And so that can become a risk, because if you maybe you only have 15 grand left in your account, and then all of a sudden you're looking at your account and you're like, what? Potential margin call? Why are these numbers red? And why does it say possible margin call? And then you get your phone rings and you pick it up and they say, oh yeah, you either need to close out your position, which by the way is at a loss now. In 3 days, it's 99.99999% likely that this is going to be a huge winner for you, but it's a small loser for you. Now, you're going to have to close it out or give us $5,000 extra dollars. And by the end of the day, it could be another $15,000 extra. So like that's a big risk, and it kind of sucks, and it's kind of crappy. And this is the thing that the Reddit kids were complaining about, and saying how it had to be some vast conspiracy and blah 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 blah. But I mean, it's not. Like this actually literally did happen to me. I had to take a loser on a trade because of this crappy margin call scenario. But like, look, man, I've been around the block enough. I've been in the industry enough. Like, I understand why they're doing it. Like I didn't yell at them. I didn't, throw the phone. I just said, oh shit, what am I going to do? I guess I got to close it. This really sucks. But, so just keep in mind that is an additional risk that you have with some of these meme stocks, this dynamic margin risk.
Need a new Greek for that. Dynamic intraday margin risk, Dan. time to
Right.
update the trading options Greeks. Forget about row. You got intraday margin risk now, sir. I think it's time for a new edition of trading options Greeks. What do you think?
Yeah, I think so. I'm trying to think of a Greek that isn't used for some third order.
Let's just call it the Longo. Why not? I mean, I think it's a good, useful name. We'll workshop it. We'll put it out there, see what people think. But, the Longo, a.k.a. your risk of intraday market. Of course, that's now going to associate me like somehow I got burned by all that stuff. But still, there are worse things. Like the first person who has the disease gets it named after them. I didn't really have this disease, but I'll still take the naming rights. I was looking here while you were talking, Dan, on some of these places, like for Schwab, for example. I looked at they have a notice here, their updated margin requirements right now. So I was looking at that, and they've tweaked them, and it depends what you're trading out there. For AMC, for example, listeners, they now require 100% margin on stock positions. Obviously, used to be. Usually in a stock, it's 50% margin. Now it's 100%. 200% margin for short positions. So you really got to CYA on the short side. For options, you can trade long calls and puts, no problem. You can only sell puts if you have enough capital to buy the stock. So effectively, we're talking about selling those puts at the 40 strike. You have to have effectively $4,000 available for every one lot you want to sell out there. Remember, that's your max risk out there. So you can only sell effectively covered puts in AMC. And selling naked calls, they say, is permitted if you have available funds for increased requirements. They say, but there's no more information on what those increased requirements are. It's not clickable or investigatable in any way. So I guess it's up to them to decide what those increased requirements are. GameStop is even worse, 100% on the stock side, 300% on the short stock side. Short puts, same deal. You have to only sell covered puts. And selling naked calls is just no bueno at all. You can't even do it. So again, it's going to depend on your broker. It's going to depend on, even at the same broker, which underlying you're trading options on, how they're going to margin you. IB, for example, that doesn't like VIX, so they're going to tack on extra fees for VIX. So it's kind of buyer beware when you go to the broker exactly how they're going to margin you. Another thing to keep in mind, there's another way to margin options, which is called portfolio margin. This is usually better. It's usually preferable. It's usually what you want out here. It's going to do a better job of accounting for offsetting positions. It allows for correlation and margin offsets between similar investments that you don't really get in Reg T. Reg T has your standard percentages you have to keep aside no matter what else you have in your portfolio. And it's kind of old school. A lot of people don't really like it. So portfolio margin helps take advantage of that and just kind of clear that up. If you have offsetting positions, you should be margined accordingly. And that's what portfolio margin does. It also is a little bit more real time and more risk-based. It takes a more risk-based look at your portfolio and margins you accordingly. Now, again, that's a highly subjective thing. We've had a lot of people on the network, vendors and others, who create these real-time margin platforms. Think about that. Think about the horsepower involved in that, listeners. A platform that can go out and look at all these positions and calculate all your risks and max drawdowns, everything, all of that in real time, and come up with a real-time margin number that you have to maintain. So a lot of horsepower, a lot of voodoo behind the scenes. So it can be somewhat subjective. You can find, like Dan was talking about, you can find yourself getting a call from a broker maybe you didn't expect. But in general, portfolio margin is going to probably do a better job of really analyzing the real risk of your portfolio and coming up with a number that is more relevant to that. The downside of that, of course, is it requires a little bit more capital to get access to portfolio margin. Usually it's somewhere in the neighborhood of 100 grand. So for example, IB for some reason requires you to have 110 grand in your account to qualify for portfolio margin. TD Ameritrade, they want 125,000. So again, it kind of varies by broker, but it's going to be somewhere north of 100 grand to really qualify for portfolio margins. If you're listening to this show, you got 8 grand in your account, going to be stuck with Reg T for the foreseeable future. But who knows? Maybe listen to this show long enough, you'll grow that account and you can qualify for portfolio margin. Dan, anything to add on the portfolio margin versus Reg T side of the fence, sir?
Yeah, I mean, portfolio margining is really great for experienced traders. I mean, they give you enough rope to hang yourself, and then, they give you another rope. But I mean, it's a lot less oppressive. You don't run into some of the troubles you run into with the Reg T account. So, when you get to the point where you feel you're ready and you're capitalized enough, it could be something to look into, but don't jump the gun. Wait until you really are ready.
That's a good point. They do give you enough rope to hang yourself, which is, as I just pointed out, could be good, but also real-time risk margin could be a little bit more dangerous, perhaps, as well, if you're not ready. But we're always ready for some of your questions. Let's get to it. A little bit of the old mail call.
Mail call. Time to look at questions submitted by our listeners.
All right, everybody. Hope you enjoyed that kind of basic overview. And again, it was a very snapshot. Today's version of margin, it changes day by day, broker by broker, underlying by underlying. So I'm sure you'll have more questions. Hit us up with those. We'll have addendums to it as we see things evolving in crazy and interesting ways. But that's kind of a good primer to get you kicking out there in the world of options, so you're not hopefully too surprised. And whatever broker you have should have a clear page you can click through to and say, hey, here's exactly how we break down this margin, this vague notion they give you of your options buying power. And if you don't understand it, contact them. It's worth doing, because that number shouldn't be voodoo to you. It should make sense. And if it doesn't, contact them, and they should explain it to you. And if they can't do a good job explaining it to you, probably time to find another broker. All right, this is a related question we got here from Tom Dan. We could dive into this one. Tom wants to know, is there any way to minimize the margin impact of my short options trades? Let's do a related one here too. This one came in from one of our pro members on one of our pro chats earlier this week, but it's related to this topic. This comes from Anthony Papadopoulos. He likes the idea of long-term selling of Buffett puts. He wants to know if this works for retail investors. And he also wants to know, margin on the brain for everybody, is there a way to minimize the margin on these long-term short puts? So Dan, everyone wants to know how to minimize their margin on their short puts, sir. What do you have for them? And also, if you have thoughts on Buffett puts, have at it.
To minimize your margin on short puts, well, this goes back to one of the tenets that I just talk about all the darn time. It's about knowing what your trading objective is, right? And it's not, I want to make money, like what specifically is your objective? Are you selling puts because, if the stock gets down that low, you actually literally do in your heart of hearts want to buy the stock? Not just that you're okay with it, but you actually want to buy the stock because you want it to be a long-term holding? Or are you trying to skate? And if you're trying to skate, is it just sort of like a short-term trading play as opposed to an investing play? And if it is, it probably makes more sense to do something like a put credit spread instead of a cash secured put. You can get a little bit more aggressive with them because the margin is so much smaller. And, it's a lot safer too, because if the stock really crashes, you're protected. You don't have all that downside risk.
Yeah, the truth is people always want this magical secret sauce, Dan, to minimize the margin hit on their short premium trades. And really there isn't one, unfortunately. You have to have something to offset the risk. That's the only way to really make that margin requirement go down. That could be the cash you have to tie up. Unfortunately, it sounds like you don't want to do that. That's the margin. So you can also have shares of the underlying, depending on what direction your risk is. That could also offset it. But again, that's going to tie up some capital. Or also in the case of selling puts, or he says short option trades, so it could be selling calls too, doing spreads instead. Now think about that. You're selling a naked call. We talked about our XYZ example a little earlier. You're selling that 60 calls, 10 handles out of the money. Now you're effectively going to be margin on that infinite risk, right? So that margin requirement, if it's, let's say, an AMC type name, it's going to be onerous, to put it mildly, out there. Now, if you turn around and buy, let's say, the 80s against that, now your risk has gone from unlimited to $20. That's a very different prospect. And now your margin will reflect that accordingly. And that could, in certain scenarios where things are outlandish, could make the buying of ridiculous options worthwhile just to free up the capital. That's why we're seeing so many of those absurd AMC 145 calls trading for any value at all, let alone a nickel, 20, 30 cents, $1, because the amount of capital these funds and others have to tie up in their other strategies is so outlandish that they have to buy something against it. Otherwise, all that capital is tied up and they can't probably afford to have their positions on. So they have to spend some of it on these ridiculous options that they know are going to go out worthless just to free up their capital and make their position tenable from a risk perspective. So unfortunately, if you want to really mitigate your margin on the short side, you're going to have to buy something against it. Spreads are the easiest way to do it, but there's other ways you can do it with the underlying or things like that. But in general, unfortunately, there's really no free lunch in the world of options. There's no way to blast away a bunch of premium and not have some sort of stringent margin requirements as a result here. All right, next up, AJ. AJ wants to know, Dan, is it ever preferable to take off trades in pieces? For example, oh, by the way, Dan, real quickly, do you have any thoughts on his other question, the long-term Buffett puts? Do you like that as a strategy for retail, sir?
Yeah, so I'm inferring that what he means is like what Buffett did with Coca-Cola many years back.
Yeah, you sell like a 10% out of the money put 3 years out or something like that, yeah. Or 20%.
Yeah. Yeah, that works great for retail investors. This is a strategy that I've used many, many, many times. I used this during the coronavirus crash. I was mostly out of the market at the top, and I started scaling back in by selling very, very expensive puts. And yeah, works great. Works really great.
So put it down there. Mr. Dan, a fan of the Buffett puts out there. All right, AJ wants to know, is it ever preferable to take off trades in pieces? For example, if you have a long straddle or iron condor and the stock moves dramatically in one direction, is it better to take off the profitable leg and leave the other leg on, or take it off as a package? Dan, we get this question a lot. People put on these multi-directional type trades. Could be a straddle. He mentions an iron condor, anything that has those types of wings or trade spreads, really legs in different directions. What do you usually counsel him? Let's say he has an iron condor and it moves aggressively in one direction, let's say to the call side out there. What do you usually do?
I mean, it's situational, but there are a couple of commonalities, a couple of key rules that I like to talk about. One is, if I put on an iron condor, so basically sell a put credit spread, sell a call credit spread, if it moves in one direction towards the call side, if I can buy back that put credit spread for pennies, like maybe I sold the put credit spread at 60 cents and I can buy the thing back at 7 cents, like, you're crazy if you don't do that. You have to. You're crazy if you don't, because the market can always reverse and that winner on that trade can become a loser. So like things like that, 100% always do. Now that said, what do you do with the loser? And the loser in those situations, you kind of have to manage on its own as well. Like if you blast through the short call strike on that iron condor, you might start thinking about doing an adjustment or just taking it off or doing something to protect yourself. So yeah, like it is in some cases preferable to take things off in pieces for sure. Yep.
All right, we got time here. Let's do one more here. I'll give you a choice, Dan. Do you want to talk about SPY puts or time spreads or SPY puts? What do you want?
How's about SPY puts?
All right, here comes one from Junkosaurus. He might get Handle of the Week award. Junkosaurus wants to know, I think SPY will drop over the next month. So does it even matter what put I buy below today's price? If it does go down, they all go up in cost, right? So I can just sell the put for a gain. So Dan, he thinks SPY is going to drop. He wants to know, does it matter what put he buys because they all go up, right, Dan?
Well, yes and no. They all go up differently. I mean, if you go like super far out of the money and buy some put at a nickel, like it just might stay a nickel, especially if it takes 2 weeks for it to go down, right? So, just looking at an extreme example like that, maybe you don't want to do that. Buying in exactly at the money, if that move takes too long, it can get a lot of your premium can erode in time decay. So, I mean, it does matter a little bit. What I like to do in these situations is I like to say, okay, I think SPY might go down over the next month, but how far down? Down $1? Down $100? Like what does that look like to you? And then once I have that answer, and like, look, don't get me wrong, like you're never going to guess exactly right, but like you got to give yourself like a realistic range of what you think. And then once you do, model a trade, put on the trade and run it through the analyzer. Like on Thinkorswim, if you could just go to the analyze tab and, like don't put on the trade yet, but like click it and then go to risk profile, you can get a good look and see what it looks like and move the date ahead, a week and see what happens if implied volatility goes up. Model it out and see which one you think makes the most sense. Outside of giving you a couple of like extreme wrong answers, too far out of the money, right at the money, probably neither are the best choice. Take a look and just see what seems to make the most sense to you.
All right. Unfortunately, listeners, that music means we come to the close of this episode of Options Bootcamp. But hey, if you're listening live and you're saying to yourself, I need a little bit more options education in my life these days. Well, you are in luck. A rare treat. Brian never does live, right? For OPR. He's always compliance restricted. He has to do his show live today. Today, we are doing a live huddle. We start recording the live to tape stuff around 3:30, so it depends how long it takes for him to do his. He likes to do a couple of shows at once. Depends how long it takes him to do his first show. Figure around 3:45 or so. Central is when we might be going live with Mr. Brian. So if you want to get access to Brian live, rare chance, ask him some questions live there as well. We'll probably be going live in about exactly 2 hours with Mr. Overby. So take advantage of that. It's a rare opportunity. He doesn't go live, field your questions very often. So stay tuned for that. A fun huddle. But before we go, Mr. Dan, if folks want to hit you up and ask you some questions, maybe about everyone's favorite new options Greek, a.k.a. the Longo, where should they go? What should they do?
They can make their way on over to markettaker.com. Market, like stock market, taker, like take what is rightfully yours, 2 T's in a row, markettaker.com. And just hit us up on the contact us page. We'd love to chat with you and help however we can.
There you go. MarketTaker2Ts.com is the place to go. And on behalf of Mr. Dan and indeed myself, I thank all of you out there for downloading, streaming, and subscribing. Remember, of course, if you're on the Plus or the Pro side, you got to join us live right now today, so no waiting for you on the Options Bootcamp front. And you'll get a dose of Brian live a little bit later today. You can ask him your questions directly. So what are you waiting for? TheOptionsInsider.com/plus or /pro. Depends on how you want to go. We'd love to see you in there. And, of course, we'll see you back here next week, another episode of Options Bootcamp.
You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.